starting. All attendees are in listen-only mode.
Uh, Very good afternoon and welcome to all. I am Divakar, product specialist with HDFC Securities. So, I'll be the host for today's webinar. And first of all, thank you for joining us for this webinar. And today's webinar is uh, uh, we are organizing this webinar, which is for debt market outlook. And today we have Siddharth with us. Siddharth is CA, he is chartered accountant, he is CFA, chartered financial analyst, as well as he has total 7-year experience and he is from HDFC AMC. So with this, he's taking care of passive fund, he's taking care of sector and thematic products, he's taking care of debt products also. And today, as we all are aware that everybody is talking about inflation, everybody is talking about increasing interest rate. Fed has increased the rate and RBI will increase the rate. So all those factors, whether it'll impact our portfolio, how it'll impact and how it would be. So for that, Siddharth is there with us. So once again, welcome you all. And now Siddharth, it is over to you. Just take us through the debt market outlook.
Hi all. Almost good evening, good afternoon, and thank you for joining this call. So Mr. Divakar briefed me that why not have a call on debt market outlook overall, and today seems to be an apt time to discuss debt market outlook because the U.S. Fed, which is the American Central Bank, they have come out with their bi-monthly statement on how they are perceiving monetary policy. They increased their monetary policy rate by another 25 basis points, that is 0.25%. So first things first, what are fixed income assets, right? How they are impacted by rates. Why are we talking about this being a time to accumulate fixed income or debt assets? And hopefully we would have a meaningful discussion today. So fixed income assets are typically investments, mutual fund investments or other investments which have invested into government securities, corporate bonds, and any such instruments which have a periodic coupon that is being paid to the investor. Fixed income mutual funds are of various types and categories. You have mutual funds which invest in very short term papers, that is debt that will mature in 90 days, 91 days. You have mutual funds which invest in very long tenure products, such as our HDFC long duration fund, which invests in 30 plus years of paper. So you have very different kinds of mutual funds available in the fixed income space. You have the credit risk fund, you have a corporate bond fund. We will not go into the details of each and every type of fund, but so just to give you an idea, these are the type of fixed income investments available. What income investments do is that they earn a return and preserve wealth for the investor by earning a coupon on the invested money, that is the interest that is received, and B, capital gains and losses on account of changes in interest rates. So if say you've invested in a fund that invests in 3 or 5 or 10-year kind of maturing products, that is slightly longer duration, changes in interest rates also changes the asset value of the product. For example, if say you invested in a product which has a 3-year maturity with say a modified duration of about 1.5. I will not go into the details. I mean, modified or MAC duration, as we call it, is sort of a indicator as to how long that the portfolio of investments within that portfolio is and how sensitive it is to rates. So let's say yields fall or increase by about 1%, so that portfolio value will also increase or fall by about say 1.5% if the duration is 1.5. So broadly, what we are saying is that today we believe that if I were to just put the bottom line up front, on account of changes in the risk and the financial stability sentiment, changes in global growth and inflation, the way we see RBI's monetary policy evolving, the way we see monetary policy having seen a large amount of rate hikes in the recent past, we believe that today investors should consider increasing duration in their fixed income portfolios. That is, A, one should have fixed income exposures, and B, the duration of those fixed income portfolios should see continuous increases in their portfolio. Now, why we say this, and I will lay some context. Over the past 2 weeks, global fixed income markets, global interest rates have seen huge volatility. All of this started, a couple of weeks back with the federal US Fed chief, Mr. Jerome Powell, sort of coming on and saying that interest rates could continue to see much higher rates because the data that was coming out of the US economy was very strong. So markets sort of factored in even 0.5% hikes for today's policy. But then something sort of interesting happened is that a couple of regional banks in the US, and in fact one global European bank, also sort of faltered, uh, which became a risk to financial stability all across the world. Because we all have seen how 2008, 2011, 12, 13 so financial stability playing a huge role in global turmoil. So obviously for global central banks, for global governments and central banks, it is very imperative to ensure that financial stability is in place. Otherwise, all bets are off. So in what can be termed as dramatic, two major US central banks collapsed on account of there was some HTM losses that they had. That is, there were some losses in their investment portfolio because what we had seen in the recent past is interest rates had increased very quickly, and as I explained earlier in my conversation, an increase in interest rates often leads to a fall in the values of debt assets. So these banks which are sitting on long dated papers, long dated debt assets, they saw very sharp falls in values of their debt assets, and as a result, their market value of assets were lower. But keep in mind that had they held it to maturity, which is what they had intended to do, they would have still made whole uh, on their portfolio with the interest that they had sort of locked in at the beginning, right? So anyway, uh, so where was that? Yeah. So, but there were these losses, and these led to a run on the bank, sort of a quasi run on the bank, because a lot of people started trying to withdraw money from their savings accounts. There were other reasons for these withdrawals also, natural reasons, but once these sort of losses started to be taken into account by depositors, there was a rush on the banks, and both of these banks had to be taken over or resolved by the US equivalent of depository insurance, right? Deposit insurance. Uh, Similarly, Credit Suisse, which is a large European bank, a systemically important bank, also saw troubles on account of their investment and investment banking activities. As of now, all of these have been resolved with either the deposit the regulator solving it, or mergers happening. In the case of Credit Suisse, we've seen UBS, which is also a Swiss bank, take over Credit Suisse. Now, what does this lead to, right? Uh, in terms of the US Fed, the idea, the expectation from the markets is that instead of a very strong hiking cycle, we are probably around the peak, and post the next policy meeting, we might actually start seeing cuts in the Fed rate. Uh, in terms of financial stability, while these regional banks are not very huge, they do form a very large part of a few specific sectors such as commercial and residential real estate, consumer and industrial sector. So even though these are small, these are important from a US economy point of view. Uh, so it is very important for the US Fed and the government to ensure that there are no more failures or minimize the damage there. On account of a lot of these factors, the expectation from the market is that the Fed may not go ahead with very strong hikes from here. In today's statement, the US Fed, however, did mention that there is room for higher rates and they will continue to hike rates until inflation sees higher moderation. Uh, Having said that, the market as it stands does not expect hikes in the next policy meeting and expects rate cuts going forward. Coming to what's important for us as Indian fixed income market investors, first we thought that let's see if there is a similar risk of contagion in Indian banks, because even in India we have seen some increase in interest rates. We have seen uh, RBI increase its rates by almost 2.5%, effectively 3%, because they have also reduced the liquidity in the system. So that also has led to increases in the interest rates. Now, in India, we have very stringent and very strong regulations around how liquid the bank assets should be, how liquid the bank portfolio should be. Things these are these finance terms such as the liquidity coverage ratio, how much you can invest in an HTM book, how much capital you should have. So RBI has sort of through its regulations made a very stringent constraint on the Indian banking system, which a lot of analysts sometimes rue. But in times like these, it becomes very safeguarding, because it lends confidence to the system and helps us know that the chance of such bank failures is very low. In fact, since about 2016, we have seen a bank, an asset side cleanup where NPAs have been cleaned out. They have been recognized well. In fact, the NPA ratios are now falling to below 1.5% at about 1.3%, and capital adequacy, that is the capital amount in the bank, is significantly high across the system at about 16%. There are risks to the Indian system because of the dollar possibly strengthening, some outflow of foreigners if there is what we call a risk off. That is when people want to take out money from risk assets such as emerging market equities. However, what we are seeing is that A, we have adequate foreign reserves. B, our trade deficit is sort of on a structurally lower path because things like the services export are helping, manufacturing goods export are helping, and the crude oil prices are also lower. They are now actually lower, below than $75 for a barrel. This had approximately touched about $120 with the Russia-Ukraine war. So, all in all, on the external front, things are not there to worry. Uh, ha- However, from a monetary policy point of view, right, we believe that while the Indian RBI and the Indian monetary policy will consider all of these global events, they will also see the fact that Indian inflation has been coming down and is now just slightly above the RBF range of inflation that they are targeting. which is approximately 2 to 6%. So our current inflation is between 6 and 7%. It is lower than what we've seen in the past, and expectations are that inflation will see sort of some smoothing over the next few months because of higher base effects. So we believe that the RBI could factor in the fact that the Fed is going for possibly lower rate hikes. There could be potential for them to wait out and see the impact of the previously done rate hikes. Uh, and the fact that there's a highly uncertain global environment. Uh, so considering all of these arguments, we believe that the RBI is very close to its peak rate in terms of the repo. And from here, there is not very significantly higher rates going forward. Also, we believe that rate hikes, if any, are largely priced in the current yield levels. So, given these risk-off sentiments, given these global developments endangering financial stability possibly, given the uncertainty on global growth and therefore inflation, given our RBI and monetary policies need to assess the impact of rate hikes that are already done, we believe that currently investors could consider investing in fixed income assets because the yields are already very high, above 7% across the board for government securities. And as you move down the credit curve, you have the potential for higher yields. So, given high yields, given the fact that we are close to the peak hike cycle, we believe it is time to accumulate in fixed income assets. Hope I was clear till now, Mr. Divakar.
Yes, that you are. So even we start getting some questions also. So whatever you have said and like whatever discussion which we had. So as of now, so the thing is like yes, it is inversely relation. Whenever we'll increase the rate, the NAV will go down. So that normally happens in the fixed income product. So whatever that product which we are having already, so there would be some kind of correction, small correction we can say, because in rates are increasing. And what Siddharth has mentioned that yes, it is a peak. So going forward, even if you are buying some debt funds, and what I believe is like if there'll be if rate cut will start, definitely the NAV of the debt schemes will start moving up. So that is the one thing I think we should keep in mind. So there was a question like when one customer is asking like, please suggest a few debt mutual funds with debt and growth and monthly payments. So whether we should go for those things and is there any tax implication? So if you can suggest that also, and I believe you have some so in the screen I can see some schemes. So if you can just brief us about that first and then take this question.
Sure, sure. So some of the schemes that investors could potentially consider on account of the view that we just spoke of, that is yields possibly peaking out and the yield curve being flat. So depending on how long your investment horizon is, that is, do you want the money back in 1 year, 3 year, 5 year, or a slightly longer view? Depending on your investment horizon and your appetite to take risk, that is, even though we believe that interest rates could only go lower from here, there is always the probability that other events, unforeseen events, new information comes in that leads to rates moving up. So, for example, in a long duration fund, HDFC long duration fund, where we have a macular duration of 132 months, that is approximately 11 years, an increase in rates by say about 1% or even 50 bips, right, could lead to a approximately say 6% fall in NAV. So one should be very wary of the duration risk that fixed income portfolios have. Similarly, if interest rates were to fall say by about 50 bips from here, one could potentially see a 6% gain in NAV. So it all depends on where rates move from here, and over time the portfolio continues to accumulate the sort of YTM or the yield to maturity that it has. So it's a constant journey between the increment gained on account of the YTM, that is the yield to maturity, and on account of the duration risk that you have. Interest rates keep moving up and down, and accordingly your your NAV could move up and down. So considering the above view, what we sort of chose to show is these few duration based schemes. On the screen you can see the short term debt fund, the medium term debt fund, and the long duration fund. If you see this column on average maturity, this sort of shows how as you move from top to bottom, the duration on these portfolios continues to increase. uh, the short term debt fund invests in largely very low maturity products. Excuse me. And the medium term debt moves slightly higher. The long duration debt is extremely high at more than 10 years, currently at about 30 years. In terms of the theme-based schemes, we've placed the banking and PSU debt fund, the corporate bond fund, and the credit risk fund. What I'll do is I'll quickly sort of take you through pointers on the corporate bond fund and the medium-term debt fund. Just a second.
Till the time Siddharth is just changing the screen. So basically, duration plays a very important role. So longer the duration, more the impact would be. So over here, what we can say is if the duration is like, yes, if the duration is 10 years, so definitely even 1% change will make the difference. So that's how what we have seen. So if the horizon is little short, definitely we can park the money wherein the impact of rate hike is less. And from here, what Siddharth mentioned, that the chances of rate hike now onwards is, so rate is at the peak. So from here the chances is a little less wherein the rate hike would be. And yes, rate cut is always advantageous for the investors who has already invested and when the rate cut will happen. So that's how it's a good time wherein we can see we can just park money in these funds wherein, yes, as per the time horizon, as per the requirement. Yes,
So
Siddharth,
yeah,
over to you.
so I've sort of displayed the short-term debt fund, some key pointers. So as you can see, the macular duration of this fund is always maintained between 1 and 3 years. So it's on the shorter, relatively, smaller size of the yield curve. Currently, the residual maturity is at 3.7 with a modified duration of 2.19, right? This scheme always keeps uh, modulating duration based on our view of the interest rate environment. And currently, as you can see, it's slightly on the higher side, right? The investments is always in AAA or A1 plus rated securities. As of Feb end, 80% of assets were towards AAA assets. One very interesting point that we worked on is that since December 12, whenever the YTM was greater than 7%, the subsequent 3 years returns for this category of fund was more than 7% in 91% of the cases. And since inception, anyway, this fund has yielded more than 7% returns in 92% instances. So we believe that this fund is suitable for investors having a horizon of more than 12 years, 12 months, and you could park short-term surpluses in your salary, in your bonus, in these categories of funds till you await deployment in longer duration products or say equity or other assets. So just like this document, we have similar documents for some of the other schemes that I mentioned, but I will not go through all of them. I'll just go back to the screen that we were on. Just a second. Right. So So we covered the short-term debt fund. The medium-term debt fund is of a slightly higher duration. Current YTM is higher, but that's sort of also on account of slightly higher credit exposure that this fund has taken. In terms
Sorry,
because
sorry to interrupt. We cannot see the screen.
oh, sorry. Yeah. So so this the medium term debt fund has a slightly higher YTM, but that's also on account of slightly higher credit exposure that this fund has taken. Currently, G6 form about 24%, with total AAA being at about 41%. It has exposure to AA plus, AA and AA minus of about 6% and 23%. So that sort of takes the total credit exposure to about 71% within the scheme. Uh, so this is obviously a slightly higher risk product in terms of both duration and in terms of credit. So we recommend investors with a slightly longer duration and higher risk appetite to consider investing in this fund. The HDFC Long Duration Fund is a predominantly government security fund. So very low credit risk here, almost very low credit risk, relatively low credit risk, but very high duration risk because the average maturity of this portfolio is 330 months. So that's a very long period. We invest in 30 plus year papers here. Uh, and the max duration is of about 132 months or almost 11 years. So this product is a sort of following a roll down strategy, a buy and hold strategy where the fund will continue to buy and hold papers of between the 2050 to 55 year category, and could be used by investors either with a very long investment horizon of more than 10 years to have visibility of some YTM gains over a very long time, or they could be used by investors to take calls, directional calls on the yield movement of the yields. Uh, I will not cover the theme-based schemes in detail here. The banking and PSU bond fund has a very high credit exposure of about 70%. Most of it is in the AAA category, 78% approximately. Uh, the max duration of this product is about more than 2 years. So slightly lower interest rate risk, but higher credit rate risk. The COP bond fund, right, in contrast, has a slightly higher duration of about 36 months. The credit exposure here, AAA is about 71%, and GSEC within that is 25%. So approximately 71% credit exposure in this product. Both of these products are recommended to investors with a recommended investment horizon of more than 1 year. If you notice, none of these have less than 1 year because we believe that while less than 1 year products such as the liquid fund or ultra short fund are great to park their products, but these cannot be really used for the possibility of having gains on account of fall in yields, right? In terms of just playing the yield curve, right? One could also consider investing in what are called as target maturity funds. I'll quickly cover the concept in brief. So target maturity funds are open-ended passive schemes. Passive is that by passive we mean that the fund manager has lower flexibility in terms of what he can buy or sell. The fund manager buys or sells securities that help him replicate the composition of a predefined fixed income index. For example, if we take the HDFC Nifty GSEC December 2020 index fund, it follows the Nifty GSEC December 2026 index, which is published by NSE indices, that is Nifty indices. This index has a predefined composition of securities, and this index fund will try to replicate that in the best possible manner within SEBI guidelines. So target maturity funds are passive funds which have a buy and hold strategy similar to what we saw in the HDFC long duration fund. Uh, this is an interesting and important point that holds true for all debt products. That is, if you hold for more than 3 years, uh, there is an indexation benefit that investors can use on their long-term capital gains. That is, uh, say gains are of about 20%, and within those say 3 years, 3.5 years, based on the cost inflation index that is published publicly, if your cost rises by X amount, then you pay capital gains only on the difference of your gains minus the increase in cost inflation index. So you could go back to your tax advisors to understand this better. But the idea is the cost inflation index moves according to the financial year. And since we are close to the financial year end, that is 31st March is the financial year end, if you invest pre 31st March and hold it till more than 3 years, say, and invest after 3 years from today, 3 years plus a few days, that is in somewhere in 2027, you get indexation benefits for 4 years. So that's something that one could possibly lock into at this juncture and possibly gain out of. Another key feature and benefit of TMFs or target maturity funds is that unlike its sort of similar product, which is the fixed maturity product FMP, this provides very high liquidity because one could transact at any time, or you could choose to hold till maturity. So there's a lot of flexibility that target maturity funds provide. We believe that target maturity funds are best suited for investors who have very matching investment horizon. That is, if you're expecting, some large expenses, some large large outflows to happen somewhere around this index maturity date, then one could possibly consider investing into these schemes, because there is potential visibility of returns where you could look at the average yield that is on offer and take into account some downside on account of expenses, on account of reinvestment risk, on account of deals not happening at the right values. But largely there is a visibility of where the portfolio could end up being at. So these are some of the index fund products. We after release of this material, we've added 4 more index funds. So we have in target maturity funds across the yield curve, largely GSEC products. So December 26, June 27, we have one ending in 2029. We have 31, 32 are visible here. We have one ending in 36. We also have an SDL product which matures in 26. So in terms of alternative debt investments or traditional debt investments, we sort of compared target maturity funds and active debt mutual fund schemes. This is a very interesting table in my view. Both TMFs and the active debt mutual funds, such as the HDFC short-term debt fund that we spoke of, they have very high liquidity in terms of daily redemption and subscription being possible. That is on business days. Indexation benefits of more than 3 years. Tenure is fixed in target maturity funds. That is, they mature on a certain date. And for active debt mutual funds, they are flexible, open-ended, indefinite products. In terms of portfolio, they are quite diversified as per SEBI norms. And the duration risk for target maturity funds keeps falling as we move towards maturity, and for active debt mutual funds, they typically are in a range, but are designed to be constant products, indefinite products. So that's about it from my side. Happy to take questions, Devakar.
Yes, sir. So basically, we have questions from the customer. So one customer just wanted to have an idea on guild fund. So what do you think? How the guild fund would be at this point of time if somebody is going to buy guild fund?
Yeah, so the guild, just a second. The guild fund follows a GSEC only strategy. That is, it invests in government securities. Uh, it, as of, I think, the month end, the guild fund had a maturity of about, uh, just a second. Yeah, the guild fund had an average portfolio maturity of about 5 years, which is slightly on the higher side. So there is significant potential for, uh, you know, uh, in case yields fall, there is potential for gains there. The credit risk on this portfolio is quite low because it's 96, 90, almost 96, 97% GSECs. So one could definitely consider investing in the HDFC Guild Fund, but with a slightly higher investment horizon of at least 18 months, because that would allow the heavy volatility on account of NAV movement to sort of give them a good experience over this volatile yield curve.
Okay.
In terms of
So
the duration call, HDFC Guild Fund has sort of over time increased duration because, given our view on interest rates and the yield curve.
okay.
Sorry.
So yeah. So we have another question wherein like the question is what about companies FD? So there are many FDs like Shriram and all. So there are companies FD. So what do you think? What is the better option in debt product? So companies FDs are also good, or debt mutual fund is the option which we should look at?
So obviously, which product to choose is always on the investor. But just like what I was showing in this target maturity fund, that table that we offered, right? Uh, we believe that target maturity funds and active debt mutual funds have certain benefits that score over traditional FDs and saving bonds in terms of how liquid and flexible they are, in terms of how diversified they are, because you are investing across products, and in terms of target maturity funds, then they are largely towards GSEC and extremely transparent about it. So, in terms of portfolio diversification, portfolio quality, uh, since they are well diversified and regulated as per SEBI norms, they score over in terms of portfolio diversification. Uh, at times, you could see possibly that yields could be offered yields, quoted yields on, so certain products could be higher for single company FDs. So one could look at what the costs and benefits are. One could look at yields on a post-tax basis. That's very important for investors to consider, because pure interest is taxed as per your individual tax bracket as dividend or interest income. And in terms of growth plans of debt funds, then if you hold for more than 3 years, you have long-term capital gains with indexation benefits. So I hope this helps you answer that question.
So I believe indexation plays a very important role over there. Correct, Siddharth?
Yes, yes. Indexation benefit, and I would also take into account, as I mentioned, the portfolio diversification that mutual funds offer, and the liquidity in terms of, if you, for any untoward happenings, in case you need to withdraw earlier than what you had earlier anticipated, mutual funds allow you to do that quite well.
And yeah. So we have
Sorry,
one more
really,
question
I was sort
wherein
of trying to show this table once again. Sorry. So I was sort of trying to show this table to
this is yeah.
reinforce my point on company bonds versus mutual fund portfolios. Yes, you can go ahead. Sorry.
Yeah. So we have another question wherein like debt funds help us protecting capital along with fixed return with the help of indexation benefit based on risk appetite. How much we should consider investment?
Right. So you would appreciate that in terms of our MBA days, we used to have answers around insufficient information. So this is a case of insufficient information. But from what I can gather, right, uh, how much to invest is obviously depending on your the advice that you get from your financial advisor. One should determine investment plan, an asset allocation, goal-based investments. Accordingly, one should look at fixed income assets as well. Fixed income should be a part of every portfolio, we believe, because they offer lower volatility in asset prices, unlike equity, which is a relatively volatile product. So and score well in tax efficiency in low return products. So fixed income should be a part of your portfolio. How much is something that I would leave your advisor to sort of advise you on. Traditionally, in the US, we've seen that and in India also, that there is a 60-40 portfolio that people recommend. That is 60% equity, 40% debt. But that's a very simplified approach, highly simplified approach to things. One should take the help of registered financial advisors to understand what is the right asset allocation based on your needs and your situation.
Okay. So Siddharth, what do you think, Matlab, from here, if we'll talk about if somebody is entering into the debt market and if there'll be some rate cut, so whatever yield which we are quoting now, so is it possible to get more than that, or it would be around that only if the horizon is very similar?
So are you saying, for example, if you invest in, say, 26 December 26 index fund, and if your horizon is also till 26, right?
Correct. And
Okay, so
if sorry to interrupt, but what I'm saying is like if there'll be rate cut and in between if I want to withdraw a fund, so would it be better? So the returns would be better than that, or how it would be?
right, so two things, right? If you have the need for that money, if it is very similar to, say, in case of the December 26 fund, if it is very close to December 2026, some few months above and lower, and say you invest today in March 23, and say by March 25, say interest rates have fallen significantly. So in that case, yes, your NAV movement will is likely to be having grown at a rate faster than the 7.32%. But what you are bound to find on that day is that since interest rates are lower, right? Even though in these 2 years you have gained higher than 7.3%, let's say for the sake of assumption you earned 8% in those 2 years, because rates fell, so NAV moved at a faster rate.
Yes.
You earned more in 2 years, okay? Theoretically, as on that date, your 1 year yields would be lower, and therefore, for what you will earn in that 1 year, average of those 3 years would, at least in theory, be around the 7.3%. So, in case you have matching maturity, that is, if your expected utilization of that money is close to the maturity date, and then if yields move down and therefore you've made some gains in those 2 years, if you redeem, take advantage of those higher gains and reinvest, since your reinvestment will be at a lower value, theoretically, your overall gain over those 3 years is likely to remain centered around this 7.3% net of, and then you will reduce it by expenses and other line items.
Okay, getting. So what you mean to say is like if you are removing the fund and if you are again trying to invest in those kind of products, so the total returns for that particular horizon would be similar. Okay.
Yes, and which is
Okay.
why
So
we say that if you have a defined date of maturity, right? Index funds can have NAV movements over the while, but if you hold till maturity, if you hold till the fund index maturing date, then the current yields are a great way to understand your potential returns, net of expenses and a few risks.
Correct. Getting. Okay. So one customer is asking, yes, the very first question wherein like customer was asking like if you can suggest some debt mutual fund. So what I believe is like horizon matters a lot. So what Siddharth has informed us, yes, if your investment horizon is matching the duration, so basically we should go for those product only. So if it is 3 years, definitely we should go for those product wherein the duration is 3 years. Correct, Siddharth? Okay.
Yes.
Okay. So even one customer is asking for the like presentation if you can share. So if you can share the presentation, we can just forward to them. Is it possible to
Sure.
share the details?
Sure. So this the note that I had shared earlier, that
Okay.
was published across our social media handles on LinkedIn, for example. I will share it with you, Mr. Devakar, and you can share it with the relevant clients, and they are also available on our social media handle and website, etc. Or if one still cannot find it, one can write to hello@hdfcfund.com, and we will be happy to provide to them.
hello@hdfcfund.com.
Yes.
Done.
I think
So I think we
we
are
are.
done with the questions, Siddharth. And uh, first of all, I would like to thanks all the participants as like taking out time in their busy schedule and joining us on this webinar. Hope we answered all the questions. So once again, thanks a lot. Get in touch with your RMs. Definitely, we have bouquet of products which we can offer. So just get in touch with your RMs. If there will be anything you can get in touch with us, wherein we'll definitely try to help you to achieve your goals and to create a pop-up portfolio for you. Thank you, Siddharth, for joining us and giving us the insight about that market outlook. Thank you, Siddharth, and thanks all.
Thank you, Devakarji. Thank you, everyone.